Ladies and gentlemen, good day and welcome to Suprajit Engineering Limited Q2FY22 Earnings Conference call hosted by Anand Rathi Shares and Stock Brokers. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vijay Sarthi. Thank you, and over to you, sir.
Yes, Zaid. Morning all. On behalf of Anand Rathi, I welcome you all to the Q2 results of Suprajit. On the management side, we have Mr. Ajit Kumar Rai, the founder and chairman, Mr. Mohan, MD and CEO, Mr. Akhilesh Rai, the director and chief strategy officer, and Mr. Medappa Gowda, the CFO and company secretary. As always, we will have a brief about the results from the management and then followed by Q&A. Over to you, Mr. Rai.
Yeah. Thank you, Vijay. I appreciate Anand Rathi to have been organizing these calls every quarter for so many years. We appreciate your continued assistance to Suprajit in reaching out to the investors. I also welcome all the participants for this quarter 2 and H1 results conference call. We have this time Akhilesh as an additional person from the management team, largely because of the recent acquisition of LDC from Kongsberg. We'll also be talking a little bit about the developments at SCC. These two are little apart from what we have been normally doing in terms of business update and operations and financial numbers. So with that the brief, I will start with Mohan to give an operational review of all the divisions, followed by Akhilesh on the LDC, as well as Medappa a little bit on the finances. And then I'll give you final comments before we open the floor for questions from all of you. Mohan?
Thank you very much. Very good morning to everybody. As usual, what I'll do is I'll give you an update on various business divisions and entities. Before we start, I'll just give you some overview. As you all know that the global demand for the passenger car vehicles continues and to be muted, and primarily because of the supply chain constraints in the market. Specifically in India, the entry level of the commuter segment of motorcycle is under pressure, and that's indicating kind of poor rural demand. The uncertainty of IC shortages and also the commodity shortages has hit all the OEMs. Therefore, the predictability has become poor. Along with that, we have a strong headwinds due to commodity and cost increases. We have been able to pass on some of the to some of the customers. We have been able to pass on the cost increases, and we are working in some other areas on the same thing. Overall, if I look at it, we have an enhanced and focused work on new product development within Suprajit Group. So let me dwell much more into details and start with the domestic cable division. Like what I said, despite the kind of cost headwinds, we have been able to do what I would call it as a 3C. Contain the increase, compensate for the increase by productivity improvements, and collect what has been increased at the vendor from the customer. So contain, compensate, and collect has been the mantra with which we have been operating at the domestic cable division. Our Narsapura plant expansion will get completed by this year, and we will be ready for the new business that we have recently won from a marquee customer. And specifically, this had to be housed there, and hence we expanded there. We are consolidating the disparate manufacturing facilities which we were using for our aftermarket cable business and overall aftermarket business as such. And what we are doing is we are going to bring in some sort of a centralized facility to manufacture, store, and service and cater to the aftermarket business. While mentioning this, I would like to caution that we are not adding capacity here, but the idea here is to release the real estate for any kind of future deployment of the new products. Moving over to the Phoenix Lamps division, here again, like other areas, we are facing extreme cost pressure. particularly in gases area, be it krypton, hydrogen, the rest of the gases, nitrogen. The gas prices have all shot up and through the sky. While we have been able to make certain price increases in the Indian aftermarket, where we still hold the pole position, therefore we are a market leader, it's taking time for us to get such a kind of increase, both at the OEM level and other label manufacturing, or OLM as we call it, and the exports. Our new HS1 line will be commissioned by the end of this year, and we are on track there. Moving over to overseas, before moving over to overseas, there is a cusp, as always, our SAL plus SCU, the cable exports division. Here again we have done pretty well, and we continue to clock new businesses. And here again we are facing the material cost increase, coupled with freight and container cost issues. We are in discussions with our customers to bear this burden, and this is an ongoing process. Moving over to Trifine Lux Light, this continues to be a challenge, and we are critically reviewing with our team in Germany and Luxembourg as to how to make things better out there. Moving on to the SENA or Suprajit Engineering non-automotive, which is part of Westcon. Volumes have picked up here again, and we are approaching the customers to again look for compensation for the cost increases. Just to give a color on what's happening at what we call as Suprajit Technology Center, or STC for short. We started this way back in 2015 with a dream of coming out with technologically innovative products. Here the idea was to come out with enhancing the value propositions along with the cables, and also look and explore beyond cables. So I am very pleased and proud to announce that we have made some significant progress here, and we have taken about 15 patents, and we are now into the fields of digital speedometer, throttle position sensor, rotary sensor, and combination braking systems mechanism, both in terms of geometry compensated and fixed ratio types. We have also launched the cedar gearboxes along with the electromechanical clutches, and this is fitted along with our rotary cables. So overall, we expect the business to be picking up here, because these are all already started to get commercialized. And we feel that STC is going to contribute significantly towards the growth of future of this company. Thank you.
Yeah, I will ask Akhilesh to give a brief on LDC, the recently planned acquisition of the light cable division of Kongsberg, and the recent updates on that. Akhilesh?
Yeah, thank you. So let me just give a quick brief on the transaction again. The EV of the transaction was about $42 million on a debt-free and cash-free basis. Considering the projected performance for this year for them at about $90 million turnover and close to double-digit EBITDA, we think this is an excellent value for our shareholders. Further, they're projecting 100 million revenue with double-digit EBITDA next year, and we believe they can hit this, especially if the global automotive, the scenario bounces back strongly post some relief on the chip and supply chain crisis that they are currently undergoing. The timeline for closing will be Q4 for us due to certain IT carve-outs that need to be done, certain manufacturing operational moves that need to be done, and of course the regulatory approvals that need to come through. But I'm just going to spend more time today just explaining some of the transformative nature of this acquisition for Suprajit. You know that we've had a global dream of being the #1 cable maker, and I think this is a big step towards that. It's important to understand that cable development and support locally is very critical for many customers. Many of our global customers have asked us to set up automotive plants in China and in Mexico, and this gives us that opportunity to now support them in these areas. This becomes especially important with more complex cables and systems that LDC are doing. This acquisition gives us that perfect low-cost manufacturing footprint to support customers and ensure that we can continue to give quality technology products on time and to the highest quality standards. Further, this acquisition and the people that are coming with it is very important. K is a global business, a global listed business in Oslo, and they come with high technology capability, good systems in place, and they have excellent engineering and sales that's right next to our global customers. So it will improve our relationship in all these areas. Finally, the acquisition gives us access to global platforms. This is a very important step for us. So with LDC's plant in China and in Mexico, we become a preferred supplier to a lot of these customers that have plants in those locations and would like a cable supplier that can supply locally and as well as export globally to them. The main engineering talent is out of Novi in the US, again close to our customers in Detroit, but they also have a great engineering capability out of the UK and Germany. Last, I would like to just add, I think there were some questions in the last call regarding the EV scenario and how this transaction holds up in the EV environment. You will notice that one of their key customers is Tesla. It's very important to understand that this company supplies to the door and seat cable assemblies that go into cars, and regardless of whether it's an EV or an ICE, you will still need your doors, your windows, and your seats to operate in the same way as they're currently operating. So we see no effect to this business with the change to EV. And probably there are even more applications of these of our mechanical cables in the EV as an alternate solution in case the car runs out of battery, for example. Key things like door opening or fuel lid opening still needs to happen through a mechanical system, and that's always going to be a fallback. So with that, I will hand this over to Medappa. Medappa?
Yeah. Thank you, Akhilesh. Good morning, everyone. We announced the Q2 financial results yesterday for the quarter and half year ended September 2021. The results are not exactly comparable with the corresponding period of previous year due to COVID lockdown scenarios. The consolidated revenue for the half year ended September 2021 was 855 crores as against 621 crores for the corresponding previous year, recording a growth of 38%. The consolidated operational EBITDA for the half year ended September 2021 was 129 crores as against 69 crores for the corresponding period of previous year, recording a growth of 88%. The standalone revenue for the half year ended September 2021 was 564 crores as against 399 crores for the corresponding period of previous year, recording a growth of 41%. The standalone operational EBITDA for the half year ended September 2021 was 104 crores as against 50 crores for the corresponding previous year, recording a growth of 107%. We are also happy to inform you that the overall group debt level has been reduced to 316 crores as on September 2021 from 327 crores as on March 2021. For any further queries, you can approach me directly even after the call also, as usual. Thank you very much.
Thank you, Medappa. Just before I let the questions come, I just like to make a couple of general comments and a directional talk. What is happening with the LDC, as Akhilesh rightly said, I think over the next 3 to 5 years' time, I believe that it's a transformational transaction for the company in a totally different league than what we have done in the past. I think our ability to have a footprint, both manufacturing, engineering, and business development in the three key continents, Asia, Europe, and North America, would truly make us a player in a completely different league, and probably the most preferred one if we play our cards right. So I think that's transformational in terms of our positioning in the cable business. I think what STC is doing, we have been doing it for the last few years, but with the new fillip of relocating into a new place with much larger facilities, test houses, and small manufacturing abilities for small batches, I think it gives us another new dimension that Suprajit on its own can develop products that would be future ready, that would stand the test of time of changing technologies, and that our engineers can deliver products which could be commercialized to any customer. I think the work done in the last 2-3 years have now fructified into specific businesses. I'm really happy to see the young team are doing a very good job. The new businesses have been won. We are reorganizing internally to make way for these manufacturing facilities. I think they are going to be game changer for Suprajit. These two are going to be, the LDC as well as the STC are going to be the game changers for Suprajit in the next 5 years. With that little brief, I will now let the questions to come. Zaid, you can please go ahead.
Thank you very much, Mr. Rai. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Srimant Dudoria, an individual investor. Please go ahead.
Yeah. Good morning, gentlemen. Thanks for the opportunity. A few questions. Firstly, on the LDC acquisition.
Sorry to interrupt, sir, but your voice is slightly off. So if you can just maybe bring the phone a bit closer.
Yeah. Is it better now?
Yes.
Yeah, I can hear you better. Yes.
Okay. Thanks. So the first question is on the LDC acquisition from Kongsberg. Now, given this acquisition is strategically so important for Suprajit, as it takes you to the doorsteps of the global customers, as a vision in the next 3 to 5 years, what sort of revenues should one anticipate this division can contribute to Suprajit?
I think, as you know, historically Suprajit has not been giving futuristic numbers. All I would like to say is that with this acquisition and once it's integrated into us, the kind of growth Suprajit will have with the LDC will be significantly superior to the industry growth. I think that's all I want to say. The reason being that we will be a one-stop shop where any customer developing and launching any product anywhere in the world, Suprajit can support them. I think that is the strength that we are offering to the customer. So that makes us a preferred vendor to these customers. So we don't talk about numbers. All I want to say is that the next year number, based on the current projections that has been given by LDC during our due diligence, is about 100 million and with an EBITDA of about 10 million. Let me also tell you, Kongsberg, because of the way they are structured, they have a much higher overheads, and we believe that we can optimize even better over the years. And the fact that we have got this transaction at $40+ million is, it's like a 4.5 times EBITDA. I think it's a great value for money. And in terms of numbers, all I can say that we will completely and significantly outperform the industry growth through this acquisition.
Right, so that's pleasing to hear. So given that there are cost overheads in this division, are there quick low-hanging fruits which you could cut down and you could increase the margins in the LDC in the near term, in the next 1-2 years?
I think 1 year will be a year of cleaning up. As it happens in all transactions, there will be cleaning up work to be done. So I don't think one should go by, let's say, what will be the result of next year. I think I'm looking at beyond a year. And from that time onwards, please understand, again, we are not taking the overhead of Kongsberg. Suprajit, we have a fairly lean operating and overhead structure. We are just taking their operating units. We are not taking their overheads of, their divisional overheads or corporate overheads into this. So I think it will not come as a part of the baggage in the first place.
Right, sir. So a few questions on the lamps division. And now, in the European subsidiaries, in one of the subsidiaries where we have taken the impairment in this quarter, Luxlight, are we due to take another impairment for Trifia in the coming quarters?
Okay, let me give a little larger perspective to all the investors who are on the call. See, the value that was there in whether it's Luxlight or Trifia is not that it was done by us. It came as a part of a transaction with those kind of goodwills or investment values sitting in their balance sheets. So it came as a part of the baggage. And when we looked at it, I think over the period of time, we realized that it was, historically was somewhat overstated, but it came as a part of the transaction. Now, what has happened over the years is that for a few years, we have tried that as a strategic intent, that having a front end, just the way we have for our cables and other divisions, having a great front end would help in getting more business. But what we have realized now, and we are regrouping ourselves, is simple. This is an aftermarket business. This is not an OEM business. So the price becomes an issue, and a low cost of delivering the whole value chain to the end user, whether it's a distributor or somebody picking up a halogen lamp from a supermarket. Value makes a lot of difference. So there is a certain overhead that is sitting there. So we needed to prune that. That's what we did in the first step by making Trifia much leaner. They had 30 people, and today they got only 3 or 4 people. And the warehouse was moved to Luxlight. Now, what is also the additional strategy that we are reviewing very critically is that it is time that we do all these things directly from India. We are looking at very focused direct export strategy and also the OLM strategy where we are working with the global majors. As you know, we work with Osram and some of the other marquee names to make sure that we are able to do direct exports out of India. Then the imperative is what is the importance of these 2 units. So the whole, I would say, strategy would change going forward. And in that process, we thought that we'll take a very conservative approach of valuing these entities. And hence, the Luxlight, we have completely taken the full write-down of the investment value. It is not partial. It is a complete write-down. And in Trifia, there is hardly any goodwill left, and they still have cash in their balance sheet. So the valuations are now fair. But I think in the next 1 year or so, with the close internal assessment as well as with the board's approvals, we should be making some final restructuring of these operations. I think it's part of when you're a global organization, there is always some cleaning up that needs to be done. I think we are taking that route over the next 1 year.
Sure, so that's helpful. So lastly, on the non-auto Sena division, cables division, so if I look at the quarterly volatility in the margins in this division, like 21% in Q4 of 21 and 16% in the first quarter and now 11%. What factors drive this volatility, and how should we look at the annual margins?
I think you should look not quarterly number. Please understand, it's not only there, it's elsewhere also. There has been significant swings in margins, quarter to quarter, quarter on quarter, last year to this year. We have been going through something like what we call as Samudra Mathanam. I think there has been fluctuations in quarter on quarter numbers, quarter to quarter numbers, half year to half year numbers. All I would like to see is that you look incrementally on half year results. Don't look at a Q2 results or a Q1 results. I think that will give a much more averaged actual scene rather than trying to analyze a quarter result. The reason is simple. the kind of variations in material cost, the kind of costs of shipments, that it's a question of if you have booked 10 containers in first quarter, it would have been an X, and if you booked the same 10 containers in the second quarter, it would have been 3X. So the variations have been different, and also we are receiving certain specific customer related pricing adjustments, maybe pertaining to prior periods coming in this quarter. So suddenly this quarter's margin either looks up, or if it is coming next quarter for this quarter number goes down. So I think looking at the individual quarter is not the right way. Please look at the half yearly results. I think having said that, I would like to say that our Sena division will continue to do well. The growth has been fantastic. The margins are stable. We'll continue to be able to do the similar margin that we have delivered last year on Sena. I think that's all I want to say.
Great, sir. Thank you so much. I'll get back in the queue.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address queries from all participants, please restrict your questions to 2 per participant. Time permitting, you may return to the queue for your follow-up questions. Our next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Congrats for a strong set of numbers, and thanks for taking my question. Sir, despite low volume in the two-wheelers, margin has seen sharp expansion in core cable business. So what is the key reasons? As we have seen that four-wheeler business has seen sharp improvement despite semiconductor shortage. So can you throw some light on the new business acquisition in export and domestic, especially in the four-wheeler side?
Mohan, will you answer that question?
Sure. I think there are 2 parts to this question. One is the two-wheeler portion, and the other one is the exports four-wheeler portion. So let me first talk about the exports four-wheeler portion. Yes, we have been winning new businesses, and incidentally, quite a few of these businesses are into the electric cars, done by traditional players, not necessarily the new guys who are coming in. So I don't need to put the names out there, but the good thing for us is that we have a stake of cables coming into all the passenger car vehicles, which are incidentally electric vehicles, which are coming into the future. So those are the businesses that we have been winning. I presume that I have answered that part of the question.
Yes, sir.
Go ahead.
Okay. Now I move on to your second part of the question, that is on the two-wheeler. Despite the volume that headwinds that we have had, how is it that we have got better results? Now, again, I allude to what our chairman was talking about. It is unfair to look at it quarter to quarter, but overall on an H1 basis, I would say that is pretty stable. What happens is, when there is a price increase that you give to your vendor, you will not be able to realize a price increase from your customer immediately, because you will have to go to your customer, prove to your customer that this is a genuine case, and based on the merits, and again, they also will look at what the other players are doing, whether they will be able to buy it at a cheaper place from somewhere else, how much those people have asked for a price increase, and net of it, they will take a decision. Therefore, the whole process takes time. So in the process, what happens is there are 2 things that will happen. One is there will be a lag. Therefore, it can get booked in another quarter. Second thing is we would probably also be doing it backdated. So in some cases, that backdated comes in as a bonanza for us. Therefore, it would be unfair to look at it Q to Q, but I would say that I'm pretty much confident to say that we have been pretty much stable on our business in two-wheelers.
So most probably the margin will hit in the next quarter, because this quarter you have gained the benefit of the past quarter's revenues. So this quarter, the next quarter, as there is a higher inventory in the two-wheeler space, and plus that mix will also change. Margin the core cable business will expected to go down.
Abhishek, I think just to add on to your point. See, again, this quarter-on-quarter number will have such fluctuations. But if you look at it, as Mohan said, there is both at the supplier side and the customer side issues when the timings are different. So that's what is seen. We have seen the previous quarters or previous period price increases suddenly hitting in Q2, and it looks like the margins have gone up. It is not. All I can say is that to answer your question about how it will affect on the longer term, I think from an Indian customer point of view on the cable division part of it, I think we have been able to fairly protect our margins, and we have been able to reasonably pass on the price enhancement to customers. Okay, give and take some here and there. So overall, to answer your question, we think that the DCD, that is the domestic cable division's margins, will remain fairly stable despite all this turmoil that we are seeing.
Okay, sir. Thanks. And my next question is related with the guidance for the margin in the Sena division on annual basis. As you have acquired the LDC business, which is a low margin business, so what is the outlook ahead for the US business margin for the next one?
You mean for Westcon? For
yeah,
Sena?
So, yeah, Sena, because that's most of the business comes from the US, and you have.
Yeah, the business comes from US, but made in India, right?
Yeah, so to some extent it comes from the plant 9, right?
Yes. See, ultimately, what are we providing? What are we providing to customer is an option, a menu of options where they want it to be made. Yes, if it is made purely in the US, there will be a little lower margin, obviously due to the higher overheads. But as we see in Sena, some of the new businesses we are winning is being manufactured, or most of it is being manufactured out of India. So that's why the margins have gone into double digit comfortably in Westcon, in Sena over the last 1 year from the previous years. So that margin, that's what I was mentioning, in the double digit is expected to be stable going forward also.
So you are going to, as you have acquired the LDC business and that is going to merge with the US business. So
yes.
Margin expected to go down in this.
Okay. You are talking about, yes, I got your point. Yes, you are right. The new entities will be acquired within Suprajit US. So you are saying the total margin in the US, Suprajit US. Okay, let me put it this way. The first year, I think I made this statement earlier. The first year, the margins may have an issue simply because we, as you know, we are very conservative in our bookkeeping and accounting. So we'll be completely making sure that everything is taken care of appropriately. But going forward, let me make it this way. The margins at double digit is what we expect these businesses to generate, number one. Number two, that you say that it's low margin compared to the India's, let us say, cable division. You are correct again. But please understand, at what price we are getting these assets? What is the return on investment? What is the ROC of the business? I think that's what we need to see. I think the ROC of getting a business of 100 million with 10 million EBITDA at $40 million US, the return on capital would be the similar to what the businesses are generating out of India or close to it. So from an overall point of view, I think it would be an excellent fit, both from the financial point of view as well as the operational leverage that we will get in our global ambitions.
So can we assume the 15% kind of the margin from the US business? I mean the Westcon plus.
No, we will not expect. But if you ask it, the return on capital employed, it will be similar to what we generate out of India.
Okay, sir, thanks. That's all from me.
Yeah.
Thank you. Next question is on the line of Pratik Kothari from Unique PMS. Please go ahead.
Hi, good morning, and thank you for the opportunity. Sir, in this press release, you have mentioned a capex plan over the next 18 months of 125 crores. If you can highlight some more details on the same, please.
Yeah, sure. Mohan, will you go ahead?
Yeah, sure. Primarily, it has got three major content. One is the buildings, the facilities, okay, the civil works in the buildings. And the second portion is the plant and machinery. And the rest I will club it as others, okay, for the sake of ease. Predominantly, a big chunk of it is going towards putting up these two buildings. One is completion of the Narsapura project, and another is what we call as aftermarket, consolidated aftermarket unit. So we call it as Unit 8. So this would be one major. And in terms of plant and machinery, primary investments are going into two areas. One is the new HS1 line that we have been talking about in Phoenix. The other one is we are investing into our electronics business, particularly like putting up the SMT line and its associated investments for manufacturing of instrument clusters. These are the two critical, I would say, major big ticket items that comes into plant and machinery. And in the others, the big ticket item is what is getting into what we call it as green energy, the solar energy. So we are putting up solar panels on most of our units to generate power. Therefore, these are the three critical areas where we are investing.
Fair enough. Just one clarification, this new line in Phoenix, this is over and above the 7 million expansion that you're doing?
Sorry, come again on this question, I didn't get it.
Last time you announced that we were putting up a new...
Yes, I got the question, Mohan. I think it is the same one getting completed. It was started. A part of it is getting spilled over to the next year. I think this year and next year. It is the same one, yes.
Okay, fair enough, fine. And so my second question on the LDC part. One, first, congratulations on an excellent acquisition. One, at a business level, not from the point where we are acquiring, but at a business level, what would be the ROC that this business would be making? And second, we did talk about certain operational benefits, etc. But once this plant is utilized, and I believe in the last call you mentioned it's partly 60%.
You are breaking up. I can't listen to you properly.
Am I audible better?
Can you speak a little louder, please?
Pratik,
yeah,
if
am
you
I
have
audible?
the phone on speaker, I would request you to please take the phone off speaker.
Audible now?
Hello?
Yeah, is this better?
Yeah, this is better.
Yeah. So my question was on the LDC part. One, at a business level, what is the ROC that they make? And second, we did highlight that currently there's quite some unutilized capacity there. And maybe over a period of time, once this is utilized, just like we did in Westcon, would that be a strategy where we would be manufacturing more of those cables out of India and exporting them and catering to the clients there? Or is this where we want to set up manufacturing plants closer to the clients, be it in China or US or in Europe, and we'll be expanding our manufacturing base out of India?
I think I would only give a generalized answer. Ultimately, it is customer is the king. We have to listen to the customer as to what they want, not as to what we want. That is the only way we can win businesses. In terms of, whether it is return on capital or whatever it is, eventually we expect it to be, if you're trying to say what will be the next year's ROC, I do not know because I don't know how we are going to go about, strategically, integrating into Westcon as well as our India operations. But on a longer term, I think based on what we have seen, because this is not the first time we have seen this asset, this was on the table 5 years ago as well. We know it is a fairly good, clean asset. I think the return on investment would be investors, people who are investors will expect from this kind of businesses as you would expect from Suprajit. I don't want to give a number, but I would say that it would be as interesting as it is from what we are doing currently on our return on capital. In terms of strategy, what the customer wants is most important. So now what will happen is that customer will have more than 3 plants to look at. I mean, customer can buy, if North American customer wants to buy from North American plant, there is a Mexico. We can offer from India. We can offer from China. So it's a customer's decision. There is an issue relating to supply chain. Why customers now are preferring closer to them is what is happening in the global shipping, global container problems. So people are today preferring to be closer home, the manufacturing plants of the supplier. So that gives us the greatest asset in this particular transaction. That will answer that question also. We can offer for Mexican plants, which is most of the manufacturing happening in Mexico for North America. We are in Mexico for them. We don't have to worry about China or India and when the container will reach. One of the biggest challenges we had in the last 1 year is to make sure our customer lines don't stop because this ship is stuck somewhere in some port, not able to unload the container. So I think it all depends upon how customer wants. but we have the footprint. That's about it.
Fair enough. And so just last on the Luxlite part, I believe the operational rationalization we have already done in the past, right? It's just the write-off on the investments that we have done in this quarter. So there are no further benefits on the operation side that we expect.
No, operational side, we still expect them to deliver better value in terms of more business for the group. Now, whether it is delivered out of Europe or whether it is delivered out of our Noida plant is something different. So that's what we are trying to deliver directly out of Noida now, not so much from stocking and selling in the Europe. So the question comes whether we need such a big warehouse already. We do have one now. Is it required at that size? What is the number of people that we need to have it to do the change scenario? This is what we will study going forward. So we just wanted to make sure that we take a conservative accounting practice so that there is no further issues on these matters.
Fair enough. And so my last question in this press release, again, we have highlighted quite a bit about chip shortages, and obviously everyone else is also talking about it. So was this the bottom, and are we seeing improved going forward in terms of orders that we receive from the OEMs, or this would still persist?
As I said I think we have also said in our press release, we don't see a change of scenario till end of March at least. I mean, hopefully there could be some improvement, but it's continued to be up and down in terms of the availability. And hopefully for the next full financial year, I think the scenario will change, and hopefully it would be much better than this year. So this year we continue to have an issue today, whether it is in India or in Western world. This quarter also having challenges, and from what we understand from customers is that Q4, that is the first quarter of next calendar year, is also an issue.
Okay, fair enough. Sure. So congratulations again and all the best.
Thank you.
Thank you. Next question is from the line of Chirag Shah from Edelweiss. Please go ahead.
Hey, thanks for the opportunity. Sir, two questions. Question one is a housekeeping one. Is it possible to quantify the price hike that we have received in the quarter?
I can't hear you, Chirag. Sorry, what was that?
Hello. Yeah, just a sec. I'll just switch my mode. Hello, am I audible now?
Yes.
Yeah. Sir, first is a question, what is the extent of price hike that we received for the earlier quarter? And what
I can't. You are garbled, Chirag.
Hello.
Chirag, your voice is not that clear when you're speaking.
Hello.
Yes.
Is it better now, sir?
Yes, it is better.
Yes, sir. My question is, what is the extent of price hikes you have received in the quarter, which pertains to earlier quarters, and whether it is for a quarter or it is more backdated in nature? Is it for 2-3 quarters that we have received?
Yes, I think the question is about the impact of the price increase on this quarter. Yes, in this quarter we have also received for the previous quarter as well as for the previous year. For example, that's what the question is.
Is it possible to quantify? Is it possible to quantify?
I think yes, it is possible. I think you can probably have a conversation with Medapa offline, Chirag. I think it should be possible.
Secondly, if I look at the standalone business, we are closer to 20% margins now on a consistent basis. Out of 3 out of last 5 quarters, we have been achieving closer to 20% margins. Now, this is way above us.
Which 20% where you are talking about?
The standalone business.
Huh?
Standalone.
Standalone, okay.
Yeah, so we had done 18 plus, then 19 plus, and now 20%. So out of 3 out of last 5 quarters, we have been almost reaching 20% margin.
I think the last 2 quarters, Chirag, let me again clarify this, has got significant price increase impact of previous year also.
Okay.
So please don't go by that.
Okay. The second side is strategic one.
And also to add on to this, I think in this quarter, we have also looked at critically some of the earlier provisioning and things that we had both at the supplier and customer ends, and some of them when we felt that was not required anymore, we had reversed that. So there is also an impact of that, positive impact of that in the standalone as well.
Okay.
So that is beyond the price increase. Let me make it clear.
Yeah. Thank you. Thank you for this clarification, sir. Sir, it's slightly strategic one. It's with respect to LDC acquisition. So if you look at our past two acquisitions, the Phoenix Lamp, we had some challenges over there in terms of restructuring, which is still in process. Okay, it is consuming management bandwidth over there. And secondly, when we look at the Westcon acquisition, we had a strategy that we can use it to expand our customer base and also cross-sell to other geographies. Some of these things haven't played out as we had hoped for. So how, when we look at LDC, we have some similar aspirations. So have you taken into consideration some of the learnings that we had from the earlier two acquisitions? They are not even questioning the price of acquisition, because even both Westcon and Phoenix were extremely cheap acquisitions. Despite the delay in the strategy, it was not a drag on overall return on capital. So I'm not even questioning that. But my more thought process is on how we are looking at it and in terms of management bandwidth that is consumed post the acquisition.
Good point, I think, Chirag. I mean, all I would like to say is that, when we are trying to grow the business, what a company who has got global ambitions, are we looking at the 3 million cars in India or the 80 million cars in the world? So obviously the answer is well known. So in that quest to acquire those markets and acquire those market shares, acquire those businesses, we take certain strategic decisions. You know very well, when we are doing a due diligence, you only see the bride dressed up well, right? So without any pun, I mean, it's with no offense, but it is all, sort of presented in a certain way. And when we really do it, there is always some change to the practical situation there. Having said that, we also know these customers and these businesses have been in place for many, many years. That means they have been delivering value to whoever the owners were in the past. So certain things work exactly the way we look at it. Certain things don't. Now, in terms of the acquisition of Phoenix Lamps division at 40 to 50 crore EBITDA for the last 6-7 years, our investment of 125 crores have been returned in more than one-fold. So, was there a challenge? Yes. Luxlight was a challenge? Yes. We have taken a call on that. But has there been a great cash generation? Yes, there has been a great cash generation. Similarly, Westcon, first 2-3 years I have told in many times earlier, we went with the existing strategy, and then we had to change the strategy. We had to change the person or the people. So we did that too. And then today we are seeing the change of things. How the business is growing in the last, US market is growing at 3%. We are growing at 20%. That means we are getting somebody else's business. So the strategy, the timing may be different, but strategy has worked well for us. Now with the LDC is becoming a lot more transformational for us. Will there be something that is not gone exactly the way we want? It may very well be, but on an overall sense, if our intent is 80% met, I think we should be more than happy. For the value that we are getting, at what price we are getting, I think we are already very much there as the best possible deal for us. But, we learn with the times, right? I mean, nothing is perfect in world. So we'll always get some imperfections. We have to ride over that. We have to correct it with time. And I think with the team's management bandwidth now, particularly with Jim joining, who is a hardcore cable guy and who is going to drive this, having run these businesses, been in that company for the last 20 years, I think it makes it much easier for us to drive this business better than what we probably have done in the past.
Yeah, thank you. Thank you very much, sir. I'll come back for more. This is helpful.
Thank you. Next question is from the line of Deepak Lalwani from Unifi Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. My question was on the acquisition and capex. So how are we going to fund these two projects, and how much debt are we going to take for this?
Generally, I think we typically do something like a 50-50, Deepak, on such matters. I think the acquisition is about 40-45 million, considering another maybe 5 million as an additional working capital or whatever. I think we'll go that also at a 50-50 way. We are already have in principle sanction in place from one of our bankers for that transaction. In terms of this capex, again it would be probably 50-50. I think again that 125 crores, please understand, will be spread over almost 2 years. I think by the time the buildings can all come up. So it is not that it's going to happen over the next 6 months. So we just given a more directional capex than an actual 1 year capex or whatever it is. So again, that would be funded maybe 50-60 crores of debt we might take, and we have got enough cash in the balance sheet, as you know.
Right. So got it.
Does it answer your question, Deepak? Thank you. Next question is a follow-up from the line of Shriman Dodoria, an individual investor. Please go ahead.
Yes, sir. Thanks again. Just one bookkeeping question. The other income portion in this quarter was high at 15 crores. So was there any one-off in this quarter?
Other income, Megappa, can you answer this?
Basically, the forex fluctuation credits.
Could you please quantify, sir? How much was that?
This other income, whatever shown there is one is like forex fluctuation, and some other income such as DEPB income and which is operational nature. Those things are included in that. I can give you the breakup later also.
Sure, sir. Thank you.
Thank you. Next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Sir, how much capex plan for FY22 and FY23, including acquisition of LDC business, and how much gross block addition can happen in these 2 years after the acquisition of LDC business?
In terms of gross block, exact number, I think you can come offline and maybe get some data from Medappa. But in terms of the capex, as I said, our 125 million capex domestically is over probably the next 18 months or so. And of course, the LDC acquisition at 42 million is the thing. They're the two capexes that we are seeing. As you know, we have got nearly 300 odd crores in our balance sheet. And as I just explained, I think we typically do a 1:1 kind of a split of our requirements between our own funds and the borrowed funds. So maybe it will increase our debt. Let's say if you look at 2023, our debt probably may increase by about, 75-80 crores or so over the next 2 years. We'll also be repaying the existing one, yeah.
You are talking about capex of $125 million and $42 million?
125 crores.
Okay. And 42 million?
42 million is for the LDC acquisition, yes. That is in dollars, sorry.
Okay. And sir, next question is the Phoenix Lab margin that is hovering in between 9 to 10%. So, and that is because of the increase in the RF cost. So, what sort of the plan do you have to take it in a mid-teen digit? Are you able to pass on the commodity cost in the near term?
Mohan, will you answer this question?
Sure. Like what I said, in the aftermarket, we are the aftermarket leaders here in India. Therefore, we took that position that we will make the first move. And there was some amount of resistance from the marketplace, but we insisted that, the commodity prices have gone up and therefore we will have to increase. After a few months later, all the other players also increased their prices. Therefore, the price parity between the competitors kind of came into the balance levels that we had earlier. So, from that perspective, aftermarket we have done. Now, the issue here is what we can do in the other label market. That means where we label it in other brands and give it to them. And also with the OEMs and their tier ones, that is the beam manufacturers. So right now we are engaging the OEMs, we are discussing with them, And with one OLM, we have already got a price increase also. Therefore, this is a process, but please understand that this market is not used to giving price increases, particularly in this commodity. Therefore, for the first time, we are going in front of them and talking to them, showing the numbers, telling that gases price has gone up, glass price has gone up, moly price has gone up, tungsten has gone up. Therefore, they are not used to it. Therefore, it will take time, but definitely we will prevail on that.
Okay, sir. Thanks, sir. That's all from my side.
I think it is 11:55. We will take maybe a couple of more questions, Zaid. We have got another hard stop at 12. So
Definitely, sir. So we'll take our last two questions then, sir. Is it okay?
yeah, sure.
Thank you. Our next question comes from the line of Nikhil Kale from Axis Capital. Please go ahead.
Thank you. Congrats on a good set of numbers. So just taking one of the earlier questions on the margin front. So if I look at the last 4-5 quarters on a consolidated basis, we've been consistently hitting 16% margins, and in fact even higher in a couple of quarters. Now I understand that you mentioned that there have been some pricing increases pertaining to previous quarters. But I mean, even on the cost side, there have been certain, the input pressures have been there in, say, Phoenix, which have not been passed on. Trade costs have gone up. So despite all these headwinds, we have been doing extremely well on the margin front. So I think in the past, we've been guiding for a margin range between 14 to 16%. That has been, I believe, a target range. Do you feel that now maybe structurally the margins have gone up, and going forward with the situation turning favorable in terms of normalization of raw material prices, improvement in volumes, margins can actually further inch up and the range can maybe shift to 16 to 18%, that kind of a level?
I think we are all optimistic, Nikhil, but it doesn't happen in business. I think the moment the customer sees some prices have come down, they come running to us also. So it's a two-way street. So all I would like to say is that, Suprajit has been a very steady in their guidance, and we always said 14 to 16 is a doable, and it is a very good margin for auto component businesses. And I think we'll continue to stick to it. I think the challenges are still not over. In fact, we just had the board meeting yesterday, and some of our CXOs are making presentations on the depth of price increases sought by some of the suppliers, particularly steel, plastics, and as Mohan said, some of the PLD-related prices. They are not small. They are not 2, 3, 4%. The customer will give you 2%, 3%, 4% custom price increase. For example, Krypton glass has gone up by 10x. Container costs have gone up by 5x. Where do you pass it on? I mean, there may be some tempering of these prices. I just heard that container costs are sort of topped up. Great news, but then customer has not given it to us. So if it comes down, there may be some saving. But if it comes down a little more, they will come for a price reduction. So I think the 14 to 16 is a very good margin to aim at on a consolidated basis. That too, very well, in some of the businesses are not delivering that. It is being sustained by some other businesses. So on a complete basket, I think we continue to, give that kind of a guidance.
Okay, got it. And just on the LDC front, just had one question. Are there any pension liabilities, given that we have employees based out of
No,
Europe?
we don't have any pension liabilities from the incoming employees, no.
Okay, great. And just one last housekeeping question. So for the year, what is the kind of CapEx that we were looking at? We have done, I think, 22 crores for the first half. So what would be the CapEx for the full year?
Again? Repeat the question.
What would be the CapEx for the full year, FY22?
For the current year, huh?
Yeah.
So, what has happened is that we have reviewed the whole thing, and, there has been a lot of internal discussion on the CapEx. So what we are doing is that of course, end of the year, we'll be able to tell you what is the CapEx we use this year. But we have completely reviewed for the next 18 months our requirement of CapEx, and that is at 125 crores.
But would that be more back-ended, so more of it will be flowing in
FY23? It will be sort of continuing, because we are just starting the one major plant in Bangalore. It just started. We had the groundbreaking only recently. So it will be sort of spread over the next 18 months.
Okay, got it. Thank you.
Thank you very much. Ladies and gentlemen, we will take our last question, which is from the line of Pratik Kothari from Unique PMS. Please go ahead.
Hi, thank you for the opportunity again. So just one question from my side in terms of the opportunities that we are seeing on the inorganic side in terms of acquisition. So given this LDC, I mean, are we done for in the meanwhile, or do we have much more opportunities out there?
Are we done for the meanwhile? Certainly, yes. But are we done for the rest of our business careers? No, I don't think so. Yes, at the moment, I think we have enough work to do, and we will be focused on this. But, as you know, historically, Suprajit has always been both organic growth driven as well as acquisitive growth. So that gene is very much in Suprajit, so it will continue. But at the moment, I think this is a very important, as I said, again, I want to repeat, I think in 5 years down the line, if there are some investors who are there today, are still with us today, they will know how transformational this could be. So we will be completely focused on this at this moment.
Fair enough. Thank you and all the best, sir.
Thank you. And I would like to thank you all for the continued interest in Suprajit. I hope we have answered your questions reasonably well. If there's anything more that you need to know, you can always connect with Medappa to get some more data or information. And at the same time, I'd also like to thank Vijay Sarthi and his team at Anand Rathi for organizing these conference calls for us every quarter. And thank you very much, Zaid, for the perfect moderation of this session. Thanks a lot, everybody.
Thank you very much, Mr. Rai. Ladies and gentlemen, on behalf of Anand Rathi Shares and Securities, that concludes today's conference call. Thank you all for joining us, and you may now disconnect your lines.